Okay, so in this presentation, I want to talk a little bit about what's been going on the past week and kind of build on the fact of trying to understand kind of what's going on in the economy over the course of this past week. So I'm making this today, Tuesday, March the 31st. So I'm sure by the time I post it tonight or early tomorrow, I'm sure it'll already be outdated. So what do we know, or what do I know, basically, as an economist? What do I know at this point? I can't really say that there's a recession yet. There's a very technical definition, as I outlined in the previous lecture, about what defines a recession. Um, but it's not going to take too much to be able to predict that that is what's going to be our future 5 months from now. There's obviously a great deal of uncertainty about the public health, and we do have this relatively complete shutdown of the entire U.S. economy, and for the fact of the matter, many other large countries, those economies as well. Now, what we've seen that's been positive over this past week is that the volatility index, the VIX, meaning how volatile is the stock market, that's decreased this past week. And one of the positive things is that we saw an incredibly large, a $2 trillion fiscal policy implemented. That's been adding to that was some monetary policy. And it does actually seem that while on some level, more states are doing the lockdowns, and you do see this kind of effort to flatten the curve. At least over this past week, again, as of March 31st, you're starting to see some pretty large numbers in terms of people that will become infected and people that would die. It's hard to tell whether it's just people trying to scare one another or whether that's what people actually believe. But with all that said, what I want to do is talk about what the economy looks like right now, and I want to do that with just pictures. So I could have made slides that have lots of kind of text, and it's a little bit harder to understand. And obviously, you all have various areas of interest, so not everyone's going to be have the same areas of interest. But what I wanted to do is just talk about over this past week, as I've kind of seen things, I've been kind of capturing pictures that I think give a pretty good snapshot of what's going on in the economy as a whole or some small segment of the economy. And I just want to present those to you. And I'm going to try to do that for these remaining lectures as a way to kind of encapsulate what's going on right now. Again, 6 months from now, you're going to think I was really dumb or really smart, and none of that was intentional here. It's just what I can understand about how the economy looks right now, given what I know. Okay. So let's start first with what the size of the fiscal policy that was implemented. Significant. If you think of how large during the financial crisis of 2008, 2009, that was $750 billion, which was rounded to, in this case here, zero point 0.8. So that represented at the time 5.5% of the GDP. So stimulating the economy by 5.5% to basically reduce the severity of the severe recession that was happening. Last week's past stimulus was $2 trillion, nearly double the size of the previous stimulus. So this is the largest fiscal policy that's ever been passed, and it's quite big. Now, someone's got to pay that bill. So GFC, that stands for the Global Financial Crisis. If we look at the budget deficit at this point, it's going to be it's going to be the largest, once we actually know what it looks like. So we only have data out to about the end of the year, end of 2019, December. So already at that point, we were kind of a little under halfway to the lowest point it had ever reached, where the budget deficit, meaning the annual shortfall in government revenue versus government expenses, that the government was spending basically an amount that was 10% of the GDP more than what it had. So the size of the U.S. economy is about $20 trillion. So we're saying that the budget deficit, the annual shortfall, is going to exceed probably $2 trillion. That $2 trillion deficit is added to the debt. So obviously we're going to spend $2 trillion to stimulate the economy. We don't have the money. So we're going to have to borrow it. And that's what this slide illustrates for you, is that, again, the severity of what we're trying to do here, we're going to have to borrow all that money. And we haven't even, in the last time we did anything nearly as much as what we're doing now, which again, the closest example we have is something half the size of what we're doing now, which would be the global financial crisis of 2008, 2009. Again, that was where the shortfall was 10% of GDP. This is going to be much larger, most likely. So where's all the money going? Well, it's, we don't really... Keep in mind, we're trying to estimate things. Economists are trying to estimate where the money is likely going to. It is going to largely, for the most part, going to the poorest of the poor, and not to the very, very rich. So that's one thing we can kind of be happy about, I guess, is that the vast majority of the total tax rebates, meaning money that you're getting back from the government, is primarily going to poor people. Now, so that's really talking about that $1,200 each person would get, $500 for each kid. And I should add this because this is going to affect many of you. If you are over 18, which probably most of you all are, and you do not file your taxes as an individual, but instead your parents file the taxes and they list you as a dependent, you will not get any money at all. There's $500 for a tax filer if they have a child under 18, but there is nothing for a person who's listed as a dependent on their taxes but is over the age of 18. So, what are people going to do with the money? This is actually not that good. The whole point of giving money, $1,200 for each person, is that we actually want people to spend it. We don't want people to pay down money that they already borrowed. That doesn't stimulate the economy. And then, if you look at the second source, people are saving it. And geez, that sucks. Really, the only good thing here is this 6% of people who are going to buy themselves something they wouldn't have bought otherwise. So, there's reason to think that a lot of that $2 trillion is not going to stimulate the economy that much at all. It's really just going to be used to pay off debt and for people to build an emergency fund, largely because people are scared. People are scared about what's happening. So if we look at where, where the other point of tension is in the economy, that would be small businesses. And you can see here that in terms of people losing their job, people are losing their job primarily when they're employed by these small businesses. And you can see that fall off as we look through March here, that percentage change in number of hourly employees going to work, 65% decrease based on the same weekday period in January. That's pretty bad. We're certainly seeing that the small business unemployment is going to fuel the large unemployment numbers that we're seeing here. Now, these are kind of there's not a lot to gain from this. So all these pictures, I curate them from, meaning I capture them from basically the two publications I read the most, the Wall Street Journal and Business Week, Bloomberg Business Week. So if you want to see the original source for any of these graphs, just because you're interested, let me know. I'll happily send you the rest of the article that I'm taking them from. This is just a simple look. Let's look at people going onto Google and searching for the word unemployment. Well, that would be a lot of people that probably are looking at that situation. And that the last time people were looking at it anywhere near that much was in 2010. Now let's look at how much people look for the word file for unemployment. Yeah, that's pretty bad. It's a pretty large increase. And I don't mean to laugh here. It's really not funny at all. That's a huge increase, basically, people having to learn how do they file for unemployment. People looking up what is a recession. Obviously, it goes up quite a bit when there's probably going to be a recession. And you see that right here. What was this time period right here? This would have been the early volatility that we saw in early March with the beginning of the coronavirus, and then obviously the uptake here at the end of March. And if anything, just to kind of highlight the fact that those who are employed are working from home, that people are having to learn how do you work from home. Okay, so what is this all going to depend on? Let's look at this first over a longer time period. The Atlanta Federal Reserve Bank does a national survey on business uncertainty, meaning businesses having uncertainty about how much business they will do, how much their revenues will be. And that's obviously pretty high here. Now, this is not going back to the previous financial crisis. So, but if you look at this relatively speaking, these would be pretty significantly bad times in terms of businesses hiring individuals. But what this also, as for an economist, what this also kind of highlights for me is perhaps some of the uncertainty about how quickly businesses will hire back employees after they've been laid off or unemployed. Because if a business doesn't know how many people are going to go do business, why would they want to hire all these workers? Or more specifically, why would they want to buy new equipment or machines or a building if they didn't know what volume of business they're going to be able to do? Now, let's look at this a little bit. Let's look at this from the perspective of how much there's an expectation of sales growing. Not very much. From an index level, sales are not expected to grow very much. And if we look at other aspects of what the business world looks like, dude, no one's flying. I don't know how, right? And this is March. This is just the month of March. And this is only going to about a week ago. No one's flying. No one is flying. And that's a pretty significant drag on the economy, because if you think about, I mean, it basically reflects an economy that is shut down. When that few of people are flying, that's people going to funerals, that's, people, doctors and nurses having to fly from one location to another. That's pretty critical individuals that have to be flying if you're making that kind of decision. Now, let's look at this from the perspective of what the purchases of homes, what's happening there. So this is looking at mortgage-backed assets. and this is looking at it over several time periods here, or sorry, several years, because obviously what you see with house sales is that it's cyclical, peaking in the summer, and then, at least on the mainland, no one buys a house in December, too cold out. You can see with the dark blue line here that fall. And, there's at least some hope that maybe that will come later in the year. But what if people can't get the money to buy that house? Or what if they feel uncertain enough that they don't want to buy a significant asset like that? It might not increase as much as we would hope for. Now, let's look at durable goods. What do, in terms of consumers, what are their new orders for durable goods? Not very much. And it doesn't look very good. Obviously with the 2008-2009 financial crisis, this data is all coming, by the way, from the Federal Reserve Economic Database, FRED. During the recession of 2008-2009, obviously durable goods fell quite significantly. We're not seeing anything here, but also you got to remember the economy is shut down, so no one would be ordering anything anyway. What's going to be more interesting to see is what this picture looks like a month from now or 2 months from now. And then if we look at this from a slightly different perspective, what if we look at it in terms of shipments of capital goods? This is also falling. So this would be to firms selling capital goods to other firms. It's also not happening. So people who make capital goods are not selling to consumers, nor are they selling to firms. That's what these two graphs show us here. Now, much of what's driving the economy in a bad way right now is the uncertainty. And that uncertainty is historically high. It has never been as high as it is right now. Largely because of the scope of the problem. We don't exactly know what COVID-19, what the impact is going to be, how long we're going to be shut down, how many people will die. With other crises like 9/11, we knew what the problem was and we kind of had a handle of how to fix it. With the 2008-2009 crisis, the problem was a little bit more severe, but again, it had a scope. Now, the only thing we can say here, the only piece of bright news we can have here, is that you do see that this is kind of a, it does move rapidly from very high to very low. So it probably won't take very long, hopefully, for this to go back to the 100s to 200s in terms of the index level. And this would be with respect to the uncertainty within the U.S. If we look at this over a shorter time frame, the only kind of comparison we have here is when President Trump did the tariffs back, seems like so long ago, back in September. Things were pretty uncertain then, but this is nowhere near, that was nowhere near as bad as what it is right now. Now, let's try to understand this a little bit now globally. Germany, one of the largest economies in the European Union. What we're seeing in Germany is that businesses also are pessimistic about the future, as pessimistic as they were in the 2008-2009 crisis. And if we look at that same data in terms of businesses that are closed versus disrupted versus normal, and we try to understand, what portion of the GDP comes from that kind of thing, that most of the GDPs in the world are in Germany. Let's try to understand this here. In Germany, a little less than 40% of the GDP exists intact. And then another slightly over 50% is disrupted in some way. And 10% is just lost. It's all closed. That would be the industries, the volume of activity going on. Let's look at Spain. Spain, less than 40%, but now you have a significant chunk where it's just closed down, disrupted entirely. Italy, same thing, very small. Now you combine these black lines together and you see that all of the major European economies, only about little less than half of the economy is going on as it always has. Everything else has either been disrupted or completely emptied, closed off. Now let's go to Asia. And more specifically, let's look at Japanese government bonds. Not even during Fukushima Daiichi nuclear disaster did you see anything as bad. You see Japanese government bonds, which are basically the most stable bonds you have in Asia. They're becoming more volatile. So people are actually starting to not trust the Japanese bonds. Now let's look at China. China obviously is stimulating the economy. Now, the best data we have is about 10 days old, so about a week and a half old. But you can see a good chunk of it is, like in the United States, for either small businesses. You're mixing in here some People's Bank of China relending. That's kind of being bumped in here. But you see a lot of stimulus going on here, just like in the U.S. If we look at Latin America, and more specifically if we look at Mexico, in Mexico, we also see this slowdown in the economy below what the forecasts had predicted. Oil. Oil is rough. I don't know if any of you have bought gas lately, but gasoline is really, really cheap right now. And that's because gasoline is cheap because oil is cheap. Oil has not been this cheap since we fought with Iraq the second time, almost 2 decades ago. 2 decades ago. I remember just starting to drive and gasoline being as expensive as it is today. Because, I learned to drive about 22 years ago. It hasn't been that cheap. It's now as cheap as it was back then. I don't know how to understand that, but in terms of impact, yeah, that helps the airlines, that helps trucking companies, but it decimates the energy sector. It hurts economies like Texas, Saudi Arabia, Canada, Norway, Venezuela, countries that are selling the oil. Now, one thing we know as well is that the stock index is quite volatile. This was really cool when I kind of saw this chart. This was talking about how much does the stock market so far, year to date, so 2020, how much has it fallen on average on Mondays? How much has it increased on average on Tuesdays, Wednesdays, Thursdays, and Fridays? That on the average Monday, the price has changed on Mondays by a little less than 20%. And on Tuesdays, the day after, it's increased by slightly over 15%. So it's going way, way down on Mondays, going up on Tuesdays, and then you get Wednesday, Thursday, Friday where you're also getting decreases. That's a volatile market. Why would you want to actively trade in a market like this? Unless you're really on top of it. Now, what we know as well is that a lot of what's going on in the economy right now are the a lot of what's going on in the economy are quantitative funds, meaning hedge funds. How much are they holding in the market? Not very much. They're basically removing as much exposure as they can to the market. They're the ones that are selling. So just because you ask, so what's the impact of this? If you ask your friend, oh, are you selling your stocks in the stock market? Most of them probably would say no, like, oh, no, I'm just, kind of waiting it out. I'm not doing anything. I'm not even looking at the balance. That's a pretty normal response. But quantitative funds, hedge funds basically, are completely removing themselves from the market, and that is what's causing the volatility. Why they are doing it? Are they doing it because they know something we don't know and we're just dumb? Or are they doing it because they really need the money? We're not entirely certain at this point. But historically speaking, it's never been as much as it is right now. And you see this volatility here. Look at the dates on this. This is the time period when we have really good data. We'd be back to the beginning of the 20th century, the 1900s, 1896. Things have never been as volatile as they are today. Not even during the Great Depression. When I say that this market right now that we've experienced in the month of March is historic, this is exactly the chart that you could use to make that argument. How volatile are prices in the calendar year so far in 2020, year to date? 62%. That's crazy. Now, I wanted to include this because this is a type of investment that's really popular for some reason here in Hawaii. These are called REITs, Real Estate Investment Trusts, where basically you have a chance to basically own the real estate under the thing. So you wouldn't own the mall, but you would own the land that the mall is on. You wouldn't own the hospital, but you would own the land that the hospital is on, et cetera, et cetera. And that market has just taken a killing here over the past 3 months. What that means is that sectors of the economy that rely heavily on borrowed money, like a REIT, so that would be like a company that's in Ward Village, that's all been developed by Howard Hughes, ticker symbol HHC, right? Killed, right? I mean, the share price, if I'm not mistaken, is between $40 and $50 a share. Back in early January, it was over $100 a share. We're certainly going to see that the economy will not look the same as it is right now 2 months from now. Those kinds of businesses are either going to have to raise money or go out of business. Raise money, you say? That's right, Scheiding. Who's raising money? Meaning, who's going out into the corporate bond market and just raising cash by issuing debt? GM. It's loading up, asking for $16 billion. Ford, $15.4 billion. Anheuser-Busch, that would be AB InBev, $9 billion. Kraft, right? Making cheese and ketchup, $4 billion. Part of it could be that money's just really cheap, but the other reason is because they don't know what the future is exactly going to look like. That would be like what the airline's at, borrowing all this money. This is pretty scary. If you're trying to think about the future being positive, probably not. Why would you borrow money if you think that things are just going to return back to normal right away? And also what this puts out there is this theme I keep hearing about is the fact that corporate debt, that bond market is becoming too flooded with assets right now. And that's what you're seeing right here. So if something is high yield, that would mean that it's a little bit more likely that they might not pay back all that they're borrowing. They might not have the money to pay it all back. So the energy companies, we talked about the oil companies, when oil is that cheap, given all the money they borrowed, it's becoming increasingly unlikely they are not going to be able to pay it all back. Automobiles, right? We saw GM and Ford. People aren't buying new cars. It's not as likely they're going to be able to pay it back. Transportation. It's actually not as bad as we would think it is. But this gives us an idea of who's issuing all the bonds and who do we think is going to be able to pay it back. It's certainly not energy. It's certainly not automobiles. It's certainly not a company like GE that sells capital goods. And you can see this concern in the bond market with this graph right here. So these are distressed bonds. Distressed bonds means if you missed payments, not likely you're going to get paid back much, if anything. Almost as high as it's ever been, at least since the global financial crisis of 2008, 2009. I'll repeat again what I just said. It's when you hear on the news that, oh, we're going to open up the economy and things are going to go right back to normal just the way they were. I find it incredibly, highly, highly unlikely that that's the case, primarily because of graphs like this. Because those businesses aren't going to exist. Or if they do, they're not going to exist for very much longer. And it's not just businesses, it's also people. Look at the credit scores of people getting loans right now from the FHA, the Federal Housing Administration. Those are low credit scores. Not much higher than what they were in the 2008-2009 time period. You're an okay credit risk, but you're not fantastic of a credit risk, and you now own a home. And we better hope that you're not in the hospitality industry or in the food service industry, because you may have lost your job and now you're really not going to pay back. If you have a low credit score, you likely have saved very little, and you're probably just as likely to say, fuck it, and walk away from your house. I included this one only because I was trying to think of what are people doing at home right now. I mean, I can think of what I'm doing at home right now. Not this. I'm watching Price is Right. I'm watching my kids, and then I come to work. My kindergartner's got my son has like all these homework assignments, and I have to help him with those. But I thought, what if I didn't have kids, or what if I didn't care about my kids? What if I was single and all that stuff? What would I be doing? Well, I was actually kind of wrong on this. I didn't predict this one at all. So apparently people are smoking up, buying lots of stuff. That could help at least some of the cannabis companies out there. But I don't know. From all that I hear, this is also something where if you have to make a cutback in your budget, probably going to be this first, right? You might as well just, if this is your thing, you might as well just go into vaping and get the high that way. At least it'd be cheaper. And if you've lost your job, you probably don't want to be spending your money on this. Okay. So that kind of wraps up at least what does the economy look like right now. It looks pretty bad. And I don't have a better way to say how bad it looks than this. Okay, so on that pessimistic note, that's my overview of the economy as it exists on March 31st, 2020.